Welcome to another episode of China Update, where I provide you guys with the most up-to-date political, economic and geostrategic analysis on the world's number 2 economy. My name is Tony. Let's jump in.
Okay, happy Wednesday everybody. We begin with the Chinese economy. In a surprise move, late yesterday, Tuesday, the People's Bank of China, China's central bank, lowered the interest rates on the Standing Lending Facility, SLF, by 10 basis points, that is 0.1%. This represents the first cut in 10 months. The SLF is a monetary tool which lets financial institutions ask the central bank for short-term loans and uses central government bonds and other low-risk securities as collateral. The move suggests that the medium-term lending facility, said to be updated tomorrow, will also be cut. The market response was swift, with the Chinese yuan slumping by more than 200 points to below 7.17 versus the US dollar in offshore trading. This move from the People's Bank of China is likely connected to the data also published by the body yesterday. According to the new numbers, aggregate financing, a broad measure of credit, was 1.6 trillion yuan, $224 billion in May, lower than the median estimate of 1.9 trillion yuan in a Bloomberg survey of economists, and down year on year. The growth in economy-wide credit outstanding dipped to 9.8% year on year from 10.3% in April. US financial media outlet The Wall Street Journal writes, quote, "This reverses nearly all of the pickup since December, when China's economy began shedding its self-imposed zero-COVID restraints." End quote. Banks offered 1.4 trillion yuan worth of new loans in May, also below expectations, missing economists' forecasts of 1.6 trillion yuan. Growth of M2 slowed to 11.6%, the slowest level in almost a year. After months of disappointing numbers demonstrating that China's previously hoped post-zero COVID rebound had lost steam, the question on many lips now is, will Beijing increase the stimulus? Indeed, the government has already been employing moderate levels of stimulus, especially in the property sector, but it has so far resisted the urge to flood the system with massive stimulus like it did back in 2015 and before that in 2008. The fear is that fiscal and debt stress is so acute now that too large a stimulus response risks financial stability. But if Beijing is to achieve its growth, these last few months of data suggest that policymakers have a tough decision to make. In recent months, government agencies have drafted stimulus proposals designed to support areas such as real estate and domestic demand, including suggestions like further interest rate reductions, more fiscal spending, and further cuts to businesses. So far, the government has been reluctant, however, to put these into practice. Later in today's video, we will look at the question of stimulus as it relates to the property sector specifically. Next up, however, the 10th Arab-China Business Conference, being held in the Saudi Arabian capital, Riyadh, concluded on Monday. According to state media, Chinese companies signed $10 billion worth of investment deals with businesses and government bodies during the two-day conference. According to Saudi state media, the deals covered, quote, industries including technology, renewables, real estate, minerals, supply chains, tourism, and healthcare, end quote. But the biggest deal was between Chinese electric vehicle maker Human Horizons and the Saudi Ministry of Investment, forming a joint venture to focus on, quote, automotive research, manufacturing, and distribution of EV technology, end quote. Chinese financial media outlet Caixin writes that China is the Arab world's largest trading partner. Total trade grew to a record $430 billion last year, one quarter of which was with Saudi Arabia. In 2022, as trade with the US reduced, Chinese trade with Saudi Arabia surged 33%. Quote, one of the factors driving China-Middle East cooperation is the desire by many countries in the region to wean themselves off oil as their predominant source of revenue. For China, increased cooperation helps satisfy its needs for alternative export markets as relations with the US sour. During his visit to Saudi Arabia in December, President Xi Jinping said the kingdom was a priority in China's foreign policy. End quote. Next up, the housing sector. Hey guys, if you enjoyed today's episode of China Update, don't forget to hit that like button. Sharing and subscribing is a huge help as well. It's only me making these episodes every day. It's a lot of work, but your guys' support is a huge source of motivation, so thank you very much. As always, anyone who can go that extra mile and help keep the channel sustainable, Patreon and Buy Me a Coffee links are in the description below. There is also the super thanks function in YouTube itself. As always, thank you so much, everybody, for the ongoing support. Okay, once a previously bullish voice on Chinese outlook, now Goldman Sachs is sounding much more pessimistic. In a new report, the US bank argues that there will be no meaningful property stimulus and that China's real estate industry is expected to see an L-shaped recovery in the coming years, dragging down China's economic growth. An L-shaped recovery occurs when, after a steep recession, a sector experiences a slow rate of recovery. Of course, Goldman Sachs has no special insight into what Beijing will ultimately do, but the U-turn in its own sentiment, one that is being seen across the major American banks in recent weeks, from a player that was so bullish in the past, is in of itself quite notable. In the Sunday research note, the US investment bank told clients that Beijing appears determined not to use the property sector as a short-term stimulus tool, with the priority being to reduce the central role of property in the economy. Policymakers in Beijing may indeed want to achieve this, but the question is, as we have explored in previous videos, if you reduce the role of property in the economy, which represents anywhere from 15 to 30% of GDP, depending on how you define it, and you wish to maintain growth, even modest growth, then that activity needs to be replaced with something else. And what would that be? Exports? Consumption? That would be nice, but these are nowhere near strong enough. More infrastructure. As we have seen, not least through statements from Chinese analysts and government officials themselves, this area is as systemically problematic as property investment. Productivity gains through investment in technology. This would also be great, but again, the best case scenario for this is slow-moving gains. It cannot replace such a large share of economic activity as property so suddenly. Thus, if the property sector's activity is to shrink, then China's overall growth must slow. And this is exactly the argument that Goldman Sachs makes. Quote, "The ongoing property cycle is different from previous rounds, as policymakers appear very determined not to use the property sector as a short-term stimulus tool, due likely to heightened concerns on falling demographic demand, a shift in policy focus to support strategically important sectors, and weaker housing affordability. We believe the policy priority is to manage the multi-year slowdown rather than to engineer an upcycle, and do not expect a repeat of the 2015 through 2018 cash-backed shantytown renovation program." End quote. And Goldman Sachs isn't the only US bank harboring such notions. Morgan Stanley, in its mid-year outlook report, warned that further weakness in the property sector will likely bring more headwinds for China's growth going forward, with the bank's chief economist writing, quote, "If the challenges in the property sector deepen and bring risk aversion in the financial system and affect consumer confidence, this will cause a deeper slowdown in China." End quote. And yesterday, JP Morgan's Asia chief market strategist, speaking to US media, expressed, quote, "I think that recovery is going to be slow, but I think there also is a huge divergence between the state-owned developers, which have done better in this current rebound, versus the more private sector developers who are still struggling." End quote. We remember back in May, the rebound in home sales slowed to 6.7%, after 2 months of 30% growth, all off very low bases. The UK-based Financial Times appears to have best summed up the sentiment from these US banks when it observed in a report yesterday, quote, "In short, when looking at previous real estate market downturns, this time really does look different." End quote. Okay, that is today's episode of China Update. Thank you so much everybody for watching. Have a wonderful Wednesday, and I will see you all tomorrow.